In today's video, we are going to discuss the importance of reviewing different assumptions with whole life insurance policies. This is specifically looking at whole life insurance policies where cash value is a priority, meaning you want maximum cash value, or you're buying a policy for the life insurance death benefit, but you still want the cash value maximized, and you want to see the different assumptions, or you just want expectations set properly so you don't have buyer's remorse after the fact. So we're going to look at a case study to explain this. The case study we're going to look at is an example of someone moving $500,000 in cash into a whole life insurance policy. So step one, what they're doing is moving this cash into a policy. How they want to do this is $100,000 per year for 5 years. After the 5th year, they do not want to pay anything into the policy, not even the minimum premium. And you can easily do that with a policy if it's set up correctly, which this one is. In the next video, we go through examples that show the actual illustration based on different assumptions, the guaranteed rate, dividend rate, so you can see that the funding stops after 5 years. Why he's interested in the product is for the core benefits of the cash value, being a safe, liquid, and tax-free area to position money, tax-free, if we do not trigger a taxable event. One example is a MEC, a modified endowment contract. So reviewing different assumptions, the guaranteed values, present dividend rate, and also indexed rider values if that is available. So the example that I used for this case was a guardian policy on a 40-year-old individual, and we looked at the guaranteed values, the guaranteed rate. The product used was 3%. The current dividend rate is 5.75%. And then the indexed rider values are based on the past 20 years of S&P 500 history. Again, you can switch back and forth between the dividend and S&P 500 rider as the years pass. A lot of people we work with will elect to attach that rider and never use it. Because if we attach it and have it at 0%, meaning 0% of our cash value is tied to the S&P 500 index, we're just participating in the basic dividend, and then there's no fees assessed to the policy either. But we do have videos that provide more information on the indexed rider as well. Here's the main purpose of today's video though: assumptions, growth, how to measure it. So what a lot of people like to look at when it comes to the growth of a life insurance policy is there's two different ways to look at it or measure it. We can look at it in total dollars, or we can look at it based on the rate. So let's start with dollars. We can look at the yearly growth and then also the total gain. So for example, if I have a policy where I'm moving $100,000 per year into a policy over 5 years, that's a total of $500,000. So let's assume by the 5th year, you've paid in how much? $500,000. So this would be your cost basis. Cost basis represents the total amount you've paid in, $500K. And your cash value at year 5 is $520,000. So what that means, your total gain over that 5-year period would be the difference between the total cash value and your cost basis, which is $20,000. Now, what's interesting about this is if you elected to look at the first year where you've only paid in $100,000, so first year, you pay in $100K, and you see that your cash value is $88,000. You'll see that in the next video. What's that in terms of a total gain? Negative $12,000. Because we have less in cash value than what we paid into the product. So in looking at the total gain, what we look at there is what's the total dollar amount I've paid into the product, what do I have in cash value, and how much more or less do I have in cash value when I compare it with my total payments. The yearly growth measures the growth on a yearly basis. So for example, we mentioned earlier that at the 5th year, your cash value is $520,000. No more payments after the 5th year. So by year 6, we don't pay anything in, meaning any growth we receive is purely based on what we received from the insurance company. So if your cash value at the end of year 6 is $550K, well, that means what? That means you have had yearly growth, just call it YG, yearly growth of $30,000, because it was 520 and now it's 550. Again, on the next video, you'll see everything laid out. We've got it on an Excel sheet that just shows year over year, what's the yearly cash value growth. And then we do the exact same thing with the internal rate of return, if you'd prefer to see the rate. And with the rate, we see, okay, year 1 to 2, or let's just take year 1, I paid in 100K, I have $88,000, so that's about a what? A 12% loss there, negative 12%. However, if I have $100,000 and then it grows to 105, what would that be? 5,000 of $100,000 is 5%, so that'd be my yearly cash value growth, yearly internal rate of return. And the average IRR will take into account all of my payments over the number of years I've paid money into the product, and then the year I'm looking at the actual rate. So for example, over 20 years, if I've paid in the first 5 years, $500,000, by year 20, the cash value is just about $1 million. My internal rate of return might be close to 4% in that particular case. So when looking at the average internal rate of return, let's assume you do this, you pay in 100K per year for 5 years. That's a total of 500K, but with the average IRR, it's going to take into account each year you made that $100,000 payment. So I'm not paying all 500K up front and then measuring the average returns over 20 years. I have to take into consideration when I paid money into the product and then when it began to receive dividends and interest. But if it's 500K over 5 years, and then by year 20, I've got cash value of almost $1 million. That's an IRR, an average IRR of a little bit less than 4%. And again, you'll see that with actual numbers on an Excel workbook. Illustrations from insurance carriers will provide that as well if you request it. So it's good to look at, and it's much easier to follow compared to what I just laid out on the board there. I hope that part made sense. So that's always beneficial to look at when we're looking at assumptions. And what I want to do there is see those different assumptions. What's the annual growth? What's the total gain? Can do the same thing with the rate, but do it when I look at conservative numbers or worst case scenarios, such as the guarantees, or if I look at it based on the present dividend rate, or if I want to say, hey, best case scenario, what could it potentially look like? But seeing those different scenarios can be very, very helpful. And then lastly, the drawbacks. So this is always good to talk about so we have full awareness. Number one drawback, the worst year is the first year. I pay money in and I have less than what I paid in. 100K goes in, I have $88,000 in cash value. That's a hit, no matter how I slice it. It takes typically 3 to 5 years, if the policy's set up correctly with a minimum premium, to get my money back. What I mean when I say that is I've paid a total of $500,000 in. When do I actually get that back? And if I say 3 to 5 years at 100K per year, that means by the 4th year, I've paid in 400K. I've got one more payment to go. But if I am cash positive at that point in time, my cash value might be worth 405. So that's my break-even point. And you'll see a number very, very close to that when we go through the actual numbers in the next video. But then, last drawback, and this is not always a drawback, but it's important to do, comparing the growth with the loan interest. A lot of business owners, a lot of real estate investors we work with like to really analyze this or just see it laid out up front. Specifically, what is the policy growing by each year compared to what am I paying in loan interest each year? And then review them side by side to see, am I receiving more from the insurance company than what I'm paying them in loan interest? Or is it flipped? I just want awareness on that so I can put some real numbers behind my decision-making process. So I hope you enjoyed this video. If you like numbers and such, we're going to go through that in the next video. If you did enjoy this, please hit the like button, subscribe for more, and we'll see you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.